Well, one of the spaces that has seen huge outperformance is the financial sector, and things have definitely improved over there. In our segment Quarter Se Quarter Tak, Abhishek is here to tell us what to expect from the banking earnings in Quarter 2. Abhishek, over to you.
Well, Sonia, banking sector has been one of the best loan growth that they have seen in a while. So the loan growth for the sector in Q2 FY23 is at a multi-year high of 16.44% on a YOY basis and around 4% on a sequential basis. There has been business updates which has come in from few lenders, which shows that private banks have witnessed strong loan growth momentum and they continue to take away the market share from the PSU counterparts. So RBI has been raising rates, so have the banks. So hence you can expect the net interest margin of the banks to remain stable or improve on a sequential basis, given the fact that most of them have raised their lending rates. Now asset quality will not be an issue in this quarter. We may see improvement in asset quality with lower slippages and better recovery. Large part of the slippages may come in from the restructured portfolio. That is the expectation of analysts. Now credit cost or provisions for NPA divided by the advances ratio will be lower on a sequential basis for majority of the players. So PSU banks will not see a huge reversal in the treasury losses that they had in Q1 FY23. Although many had guided for the fact that they may see 50% of the losses reverse in Q2 what they saw in Q1. So we may continue to see private banks outperforming, or given the fact that they will be investing in the franchise as well, which may keep their operating expenses on the higher side. Now we have some of the estimates from Kotak Securities, who estimates SBI NI growth to be up about 7.5% YOY and 7.5% on a sequential basis. Net profit to be up close to 52.6% YOY and 92% on a sequential basis. For HDFC Bank, they expect NI growth of 17% YOY and 6.3% sequentially. They are expecting profit growth for HDFC Bank to be about 27.5% YOY and 22.5% sequentially. For ICICI Bank, they expect NI growth of 18.7% YOY and about 5% sequentially, while for profits they have an estimate of 35% growth on a YOY basis and 7.8% sequentially. For Axis Bank, Kotak Securities estimates NI growth of close to 27% YOY and 6.8% sequentially, while net profit they are estimating a growth of 46.5% YOY and more than 11% sequentially. Back to you.
All right. Abhishek, thanks very much for that. We have Vishal Goyal, who is joining us. He's head of India Research and Banks analyst at UBS Securities India. Vishal, great to have you with us here. Thank you very much for your time. Will the second, because we've got a lot of pre-quarterly updates, etc., and Abhishek, of course, also summarized things here. Will it solidify expectations that this is the one sector which perhaps will make a lot of money going forward? Valuations remain lower than longer-term averages. What really are your expectations broadly, top-down first?
Sure. So I think clearly we are also constructive on the sector. These tailwinds are only become stronger with loan growth coming back in the system. As the last reported data point is around 16% YOY. And the first half, generally, which is weak, and historically you saw zero growth in the first half. We have already seen, a 6% plus kind of YTD growth in the first half itself. So that gives us a strong, I would say, base for NII growth and NIM expansion as well. So ideally, I think we are constructive on the sector given the strong tailwinds. Also, when we look at historically for last, let's say 15, 16 years and multiple cycles, you will see that this kind of environment generally happens, once in 3 to 5 years. And especially coming from a very weak corporate NPL cycle in the last 6-7 years, the system has also delivered. So it's a good backdrop for another upcycle, while I'm sure there are a lot of risks which we can discuss going forward as well.
Right. Vishal, just wanted a couple of data points from you. Among the universe that you track, what has been your expectations of loan growth for this year? You said the first half was an outperformance as against your expectations, and what is the NIM expansion that you're expecting for the universe? And in that, what are the places which stand to benefit more than the average?
Sure. So clearly, when we started the year, we were expecting more like a 12% kind of system growth because there was no real capex driven growth. Now, as we speak, I think the growth is running at 16%. We feel due to base effect, it will cool off maybe towards 14-15% for this year. But still, your average loan growth will still be higher than what we started off with, maybe somewhere in March. On margins, I think we are slightly more positive than the street. So most of our estimates on margins are easily 10 basis point higher than the street. We feel the margin tailwinds are multiple. So one is the loan repricing benefit, which is a faster repricing of loan book. But I think more than that, most of the banks are also seeing loan mix shift. And because of a higher retail, higher unsecured portion in their balance sheets, they would get a higher average yield, which will support margins in the next couple of quarters.
What are the risks you were, referring to? Some risks that exist on the horizon for the banking sector. What would they be, and is any of that expected to be factored into this quarter's earnings?
So none of those risks will, immediately appear. So the biggest risk I think we have is still the global economic cycle and the interest rate tightening, which we are, seeing in the US and outside. The follow-through impact of that, as we've seen in historically, could come either in form of exchange rate volatility or excessive tightening in the local economy. So that I think would be the biggest risk to the macroeconomy of India. Also, I think if you look at consensus has been cutting GDP estimates for the next year. So that I think needs to be closely watched, because clearly in the next 2-3 quarters, none of this risk will materialize, because asset quality wise, there has been like hardly any growth in the system for last 3-4 years on the loan side.
Vishal, the mortgage financiers, home finance companies, I don't know if you track them. If you do, I mean, is that a good place to be? I'm talking about the smaller ones, not the big boys like HDFC, but there are a bunch of the smaller, very small ticket size loans, Home First and a couple others as well. Is that generally, I mean, mortgages are seen as a safer segment, right? And of course, the runway for growth is also pretty large. What's your view there? I'm only asking that now because we've got a general perception that because as interest rates go up, I mean, it's better to be with large lenders rather than go looking for opportunities in specific niche segments. Go on.
Sure. So I think we don't cover like the smaller guys, I think, but the general comment on overall, again, NBFCs or even mortgages would be the pricing power. If they have the pricing power in terms of increasing interest rates, if they can pass on that to both the existing customers and to the new customers, I think then those businesses wouldn't worry much, because there is a lot of, as you said, there's a structural demand for affordable housing or small ticket housing. So that tailwind of growth can still support those businesses. But the moment we think about larger companies where ability to pass on this higher interest rate is limited, I think generally, again, historically, if you go back and see, generally those businesses struggle at the time when the rates are rising, immediately during that period of 1 to 2 years.
These private sector banks, right, they've been growing at the NII growth this time is expected to be about 17, 18, 19% across the board. HDFC, Icici Bank, Axis Bank is expected to do much better. Is this a sustainable growth run rate that you see for the rest of the year for the private sector banking space?
Yes, we feel that this growth rate of closer to 20% for this, especially the larger private sector banks, would continue. Part of this is coming from loan growth. Also, I think you are seeing margin expansion, which we believe would continue for the rest of this year.
All right. And would you, given the prognosis of improved prospects, look at any of the public sector banks as well, apart from the largest one?
So now on public sector banks, as we have seen multiple times in past, there have been multiple failed starts. So every time, people trying to become bullish on public sector banks, there is something or the other which kept happening. After a almost 7 to 8 year period of cleanup on asset quality, finally their credit costs actually are lower than some of the private sector banks. And there is still room for some of the public sector banks to report lower credit costs. This is generally the environment when one can buy public sector banks. Now, these are always a trading, stories or tactical buys, not sustainable because their ROA and capitalization generally are weaker, and that keeps diluting shareholder returns over time. But within a cycle, for a shorter period of time, they tend to outperform for a again, depending upon how long the cycle would be. So at this point in time, they are actually better placed, I must say. I mean, we continue to like private sector banks over time because we believe more, structural stories.
Okay, Vishal, we'll leave it at that. Thanks a lot for joining in. So that's UBS Securities with their expectations on the banking sector. And as Abhishek was telling us, this time around it's expected to be a very strong run, especially for the private sector banks. Let's see, for the market, as of now, it's holding up. We have Rashmi Bhatnagar, who is the head of global equities of All Star Charts, who joins in to give us a quick check on which way the market is headed and how she's reading the charts at the moment. Rashmi, good morning and thanks a lot for being with us on CNBC TV18. I want to first start by asking you about the Nifty chart itself, because yesterday we breached that 200-day moving average, which was a psychological support for a while. How is the chart looking now and what are the key levels to watch?
Hi, good morning, Sonia. Good morning, Vishal. Nifty, for that matter, when we compare to the global indices, has been an outperformer. There's been a lot of strength and resilience coming through in this particular index. So what we're looking at from current levels is that the support comes in at 16,800, which are essentially the June swing highs that we were tracking. As long as the price trades above this level, there's no need for panic, there's no concern. But if the price does move below 16,800, it's honestly still not mayhem or panic level even then, because Nifty, for now, as of now, the market is moving in a sideways range at best. Not a bullish setup, because for a bullish setup, you would want higher highs and higher lows. For that to happen, the price has to move past the all-time highs of 600. So if we look at the price as of now, the next support that comes in would be 16,800. And we're trading in a range between 16,800 and 18,300.
Rashmi, there's some issue with your audio. So what we're going to do is we're just going to come back to you in a couple of minutes. But suffice to say that this market is looking pretty good. The Sensex is now up almost 260 points. And if you pull up the contribution plate, you'll realize that a lot of the market momentum today is coming in from some of these heavyweights from the IT space. So whether it's HCL Tech, Wipro, Tech Mahindra, all doing pretty well this morning. And some TCS, of course, is also front foot forward. But you also have HDFC and Reliance Industries that are participating. 9 points there from Reliance Industries.
So the flash at the bottom of the screen with regards to a one-time compensation likely to OMCs on LPG, which is likely to be approved by Cabinet today. We'll get our correspondent on this, but this has caused a bit of joy on all these oil marketing companies. So HPCL is at the high point of trade. We do have BPCL and IOC as well, both of them trading at the highs of this morning. So we'll just get some more clarity on this one-time compensation to oil marketing companies on LPG likely to be approved by the Cabinet today. We do have her back, Rashmi. You talk about the markets, etc. I was curious to know, while I was reading about you are a professional actor. You've acted in films. So what explains this shift from acting to technical analysis?
Well, for me, this was more glamorous. It was a better world to be a part of. Because as you can see, technical analysis is one subject where the market is a brand new day every single day. You cannot get bored of such a setup, right? Because every single day brings so many opportunities. So to me, this was more of a natural flow to move from one end to the other.
Would you like to be an actor?
This is more glamorous. This is the first time I've heard someone say that, that the markets are more glamorous than acting. But Rashmi, pleasure to have you here. And of course, as they say, the grass is always greener on the other side.
There's that green again. Rashmi, that's good to hear. So just a quick point. So you said 16,800 lower side.
Right.
Is there any level below which things get negated? Firmly, or you'd still give the benefit of doubt to what's happening?
So right now the market is in a sideways structure, which is it's moving in a range between about 18,300 to 15,500. That's the larger range that we're tracking. So only a move below 15,500 would negate this particular sideways move. Because we're not in a bullish structure, so this thesis is negated below 15,000.
Okay, that's still some distance away. What about the Bank Nifty, Rashmi?
Bank Nifty right now, so Indian banks are known to be one of the strongest sectors across the globe. You can compare it to XLF in the US. You can compare it to E1 Finance in European banks. Indian banks definitely outperform when you're looking at their global peers. The levels that we're tracking right now it's a sideways boom. So 42,000 and 32,000 on the downside. But as long as these levels hold, there's nothing to worry about because, well, we've heard time and again as to how sector rotation is the lifeblood of a market. For any particular market, a bullish market structure to sustain and to move forward, you need financials to be a part of it. You need financials to participate in that kind of rally. They don't have to outperform, but they need to participate in that rally. And right now, we're seeing that sort of an outperformance in this sideways structure where Nifty Bank is outperforming other sectors that we're looking at.
And within that, right, the chart of ICICI Bank has been very interesting. I mean, from the lows of 650 in the month of March, it's come back all the way to 880, but still a bit of a distance away from the 52-week high of 940. Do you see it get there very soon despite all the challenges? And how do the long-term charts look for ICICI Bank?
Absolutely. ICICI Bank has been one of the strongest banks to be invested in. The stock has been outperforming for quite some time. We've seen that sort of a move come through. Right now, we're tracking at 835 as the support. As long as the price trades above that, that's good for the bank. It's positive because we're looking at a longer term move. We're not looking at, weeks or days. We're looking at months ahead. So as long as the price trades above 835, the next target that we're tracking is around 1,000.
Right. The other stock that I'm tracking is Indian Hotels. This has clearly been one of the stocks of this year, very close to its all-time high, even as the markets, were volatile through this period. We've seen an 80% plus sort of jump come by on that stock. What are your thoughts on Indian Hotels? You're looking at the charts of that counter too.
Absolutely. Indian Hotels has been another winner. So we have a custom index that we create of the leisure sector. This includes all the hotels, flights, travel, everything that is basically in great demand right now. Indian Hotels is one of the outperformers in this particular sector, and just through and through, there's just no doubt about it. We're looking at levels of 330. That would be the support. The price is bullish above this level with a target close to 495, 500, but definitely an outperformer to track.
Are you watching Schaeffler India as well, Rashmi?
Yes, industrial manufacturing is another sector that's doing well. In this scenario, we have banking, industrial manufacturing, leisure, auto ancillary sort of outperforming as well. So Schaeffler India is part of that bullish thesis. 3,115, that's a risk management level. You can see the kind of move that has come through in this particular stock. It's absolutely amazing from those lows of 2020. The next target that we're tracking is close to 4,670 there.
Okay, and finally, just a word on crude for the slightly more longer term. It's currently around this $93, $94 a barrel mark, right? But any chances it could get above that? I mean, are the charts looking quite bullish?
The charts are actually looking pretty decent for crude as well. If you notice, if you look at the RSI, the relative strength indicator in crude oil, every time there is the most recent correction hasn't taken the RSI below the level of 50. So what we're looking at is that when during a correction, the price does not take the indicator below the level of 50, that's actually a positive sign because in a regular scenario of a correction, it would ideally go towards 30 or 20 towards the bottom of the range. So this is actually a better setup technically for crude. In terms of rupees, we're looking at 6,400 as a support and 10,285 would be the target level. If you're looking at levels in terms of dollars, we're looking at 76 as a support. So as long as the price trades above 76, crude is good to go. This is probably the perfect market for a range-bound trader who loves to play the ends of the game. So sell at the resistance and buy at the support. The resistance for crude comes in at 108. Post that, you could see 113 in the meantime.
All right, Rashmi, thanks a lot for joining in and giving us your views on a whole host of stocks as well as the indices and a couple of commodities as well. Crude likely to be range bound. Thank you for joining in. With that, we'll take a short break and take a cue from Rashmi's view on crude itself. On the other side, we have Manisha Gupta telling us what's happening in the commodities market.
ये वक्त है खुशहाली के आने का, ये वक्त है जीवन को रोशन कर जाने का, ये उत्सव है असली कारीगरी का, ये वक्त है समृद्धि को घर लाने का।
Traxon Technologies Limited. Initial public offering of up to 38,672,208 equity shares of face value of 1 rupee each through the book building process with a price band of 75 rupees to 80 rupees per equity share. Bid offer opens on Monday, October 10, 2022 and closes on Wednesday, October 12, 2022. For risk factors and more details, please refer to the RHP available on the websites of SEBI, the book running lead manager and the stock exchanges.
हमारी कार कितने में निकलेगी?
सर ये
वाह,
यस सर, OLX ऑटोज ही देता है आपकी कार का बेस्ट प्राइस।
सुनीता, सुना तुमने ये क्या बोल रहे हैं?
यही कि OLX ऑटोज ही देता है आपकी कार का बेस्ट प्राइस।
बाबूजी, सुना आपने सुनीता क्या बोल रही है?
ये सब यही बोल रहे हैं कि ये प्राइस ही नहीं सरप्राइज है। Visit olxautos.in.
India Bulls Housing Finance Limited announces a public issue of secured redeemable NCDs offering coupon rate of up to 9.55% per annum and additional incentive of 0.25% per annum. Tranche 3 issue is open for subscription. To subscribe, log on to indiabullshomeloans.com. For risk factors and more details, refer to the Tranche 3 prospectus available on the websites of SEBI, Stock Exchange, Company and the lead managers.
Happiness is getting home solid wood furniture this Diwali from insaraf.com, India's #1 solid wood furniture store.
दादा, आप फ्लाइट कहाँ बुक करते हो?
इक्सिगो।
ट्रेन?
इक्सिगो।
बस?
इक्सिगो।
साइकिल?
इक्सिगो।
ज्यादा बोल लिए?
बड़ो ज्यादा बोल लिया।
और कौन सा ऐप डाउनलोड करना चाहिए?
इक्सिगो।
और निकल लो।
Nickel Low Sale is now live. Get up to 30% off on flights. Use code NICKEL.
जिंदगी को दें रफ्तार, शुरू करें इसी त्योहार, खुशियों का सफर बिताएं साथ मिलकर। त्योहार तभी हो जब अपने साथ हो। SBI के संग इस त्योहार छोटी किश्त से बड़ी खुशियां ले आए। SBI, the banker to every Indian.
Welcome back, folks. It is green on the equity market screen, but what's happening in the world of commodities? Manisha is here to tell us about that. Manisha, good morning. What's the one commodity that you're looking at now?
So now I'm looking at the raw materials, and we have seen further decline in many of these, including steel and rubber is what I'm looking at right now, where the global markets are now trading at a 2-year lows, by the way. So it is China COVID breakouts, and this time around in big cities like Shanghai and Shenzhen, and that means there could be more lockdown restrictions coming in. That's weighing onto the markets. And then the markets also are reacting to the China auto sales for the month of September, while on year-on-year basis, there is a positive trend there, but on month-on-month, it does show a slowdown there as well. For Indian markets, this is the April to August trends until now. So while we have seen production increase, the consumption has been much higher and the imports have continued to gain up as well. In any case, India imports nearly 50% of its natural rubber requirements, and we have seen that trend pretty much go on there. When you look at the overall numbers on an year-on-year basis, those have been on the higher side as well. We continue, when you look at the rubber industry, we continue to look at the tire manufacturing sector because 71% of total consumption when it comes to natural rubber does come in from the tire industry there. This is what we've done in last couple of years in sense of production and consumption, where you can see that the production is increasing, but not so much. But the consumption clearly is up by nearly 12% on an year-on-year basis there. When you look at the prices also, on a month-on-month and an year-on-year basis, we have seen a decline onto this one because the demand is yet to catch up from the automobile sector there. When you look at the overall prices in this year itself, we have seen them continue to decline as well. From 170 rupees per kg in the month of July, it has been a constant decline, and the last couple of months actually have been trading within that 147 to 150 rupees per kg. That is how the rubber prices are holding right now as well. Remember, we have seen an all-time high of nearly 238 rupees, 238 rupees per kg. That was in 2011. Since then, the rubber prices have not been able to come to those levels, and the markets do believe that because of higher tapping, lower demand, you could be looking at some further pressure continuing here.
Manisha, thanks very much for that. So that's rubber in focus. Well, you know, the market's given up. It's not holding. The high today is 17,071. We were up 70, 80 points. And it's just got 30 points. 25 left now. So we've fallen below the opening level. The open was 1725, and we're just about above 17,000, 17,005, and falling fast. And this is, of course, something which is not unusual to be expected with all that is happening in global markets, etc. So relative outperformance still. I mean, falls less and on up days rises a little bit more. That's been the texture. All right, I think Ekta is with us to run us through what's happening with Marksans Pharma, which of course is jumping higher by about 7-8%. Started strong, stay strong. Ekta, over to you.
Thanks for that. Well, yes, Marksans is in focus. In fact, the reason why we are seeing this up move coming in for Marksans is because they will be acquiring Teva Pharma's Indian manufacturing facility in Goa. The company is going to be acquiring the facility basically for an undisclosed sum, and what it will do is that it is going to help them in terms of the entire unit when it comes to the oral solid dosage formulation space. So, for example, this particular plant will be manufacturing ointments as well as creams for the company going forward. It will be adding to the 3 manufacturing facilities that they already have in their, they have one in the UK, they have another one in India. So a total of 4 manufacturing facilities, which is going to help them in terms of supplies. This particular facility has regulatory approvals from the likes of Europe as well as from the likes of Japan, and hence it's going to help propel them in terms of these markets as well. So as of now, oral solid dosage manufacturing, it's a unit which was, Teva Pharma's unit in Goa, which is now going to be acquired by Marksans. It's going to probably help them propel in terms of the export market.
All right, Ekta, thanks a lot for that. So that's on Marksans Pharma. But let's slip into a quick commercial break on that note. On the other side, our special segment, It's the Economy, coming up. We'll connect with Suyash Chaudhary of IDFC Mutual Fund and Alvin Titan of RBC Capital to discuss the turmoil in the global debt market. Stay tuned.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाइड क्लब प्राइम आग से बचाए।
Will snow days be a thing of the past? Or are we smarter than that?
ये नया टीवी
Give me red.
मिहिर और मीना की शादी होती है, मिहिर के बच्चों के बच्चे होते हैं, दादाजी का पुनर्जन्म होता है।
बात अगर लंबे चलने की हो तो सिर्फ न्यू एवर रेडी अल्टिमा alkaline batteries with latest turbo lock technology that last up to 400% longer. New ever ready Ultima lasts up to 400% longer.
दादा आप फ्लाइट कहाँ बुक करते हो?
इक्सिगो,
ट्रेन,
इक्सिगो,
बस,
इक्सिगो,
साइकिल,
इक्सिगो,
ज़्यादा बोल लिए,
बड़ो ज़्यादा बोल लिया।
और कौन सा ऐप डाउनलोड करना चाहिए?
इक्सिगो।
और निकल लो।
Nickel Low Sale is now live. Get up to 30% off on flights. Use code NICKEL.
Suzlon Energy Limited, market leader in India with significant experience across the entire wind energy value chain, an established track record in the wind energy sector with more than 27 years of experience, with the largest installed base in India as a wind energy OEM. The Suzlon Energy Limited rights issue of 2,400 million partly paid up equity shares of face value of ₹2 each for cash at a price of ₹5 per share. Opens on 11th October, closes on 20th October. For more details, refer to the letter of offer.
You know, people often ask me why I left my steady job at the call center. I wanted more out of life. So, I launched my own startup. Do you want to know how? Then start up your own business as an LIC agent. You want it, we've got it. Great products, zero investment, leading organization, and unlimited opportunities. So are you ready? Now think big. Become an LIC agent.
Visit our website or contact your nearest LIC branch.
Let's talk debt. Half a dozen countries like Sri Lanka, Pakistan, Chad, Ethiopia, Zambia have already defaulted on their debt due to Fed rate hikes, dollar strength, crude rally, and many dozens of emerging economies are paying 10 to 20% on their debt. But the biggest shock to the financial markets came last month or earlier this month when a developed market like the UK saw an evaporation of buyers and soaring yields. The problem is pension funds buy hedges or enter into derivative positions to protect the bonds in their portfolio or just earn more money. When the interest rates rise even above their hedge limits, they have to bring in collateral for which they sell more bonds. And this leads to a vicious cycle of selling of bonds and lower prices. That's why the Bank of England stepped in to buy bonds and protect the pension funds. Now, Eurozone debt is perhaps entering the same danger zone as the spread between the German bonds and the interest rate swap agreements undertaken by the pension funds have increased. European pension funds also find themselves facing margin calls on their derivative positions. But the interest rate hikes are not stopping. The Fed, the ECB and the Bank of England are still in rate hiking mode because inflation is at or close to double digits in all these countries. Today, I have with me two experts to discuss whether we could see some sharp dislocations in global markets and what does it mean for us. I have with me Alvin Tan, the head Asia Forex strategy of RBC Capital Markets, and Suyash Chaudhary, head fixed income at IDFC Mutual Fund. Gentlemen, thank you very much indeed for joining me. Alvin, first to you. Looks like the UK problem is also being seen in Germany, in Europe, with funds, institutional investors having to sell bonds to provide margin calls. Do you think we are going to see an expansion of global debt problems, developed market problems?
Well, yes, as you mentioned, this is a manifestation, of the problems associated with the rising interest rate environment that we've been in, and I think what happened in the UK 2 weeks ago was certainly quite a surprise to many people in the market. And there's certainly a risk that it could spread to other parts of Europe. Certainly, Italian debt is now in focus. The Italian government will submit its budget to the European Commission this weekend. And we'll see if the European Commission authorizes this budget. But certainly, it is a rising risk as bond yields continue to rise further throughout the world.
Okay, these are sophisticated markets which emerging market equity investors don't understand much. It's an institutional market. So I just want you to interpret this for us. Do you think we could see more of a flight of capital from emerging markets simply because yields are rising there and there is a risk of?
Yes, cross-asset volatility is extremely elevated, not just in fixed income, but also, of course, in equities. I mean, it's been elevated this whole year. And on top of that, also elevated in FX, in the currency market. So definitely, further dislocation in financial markets across the world, further cross-asset volatility rises will exacerbate the outflows that we've been seeing from emerging markets and definitely push the US dollar higher and thereby emerging market currencies lower going forward. This is definitely, I think, a likely outcome in the next several months. The only question is, what is the magnitude of these outflows, the magnitude of these moves in emerging market risk assets and emerging market currencies.
Okay. Well, your thoughts on the same problem, Suyash. Can you explain to an emerging market investor how these rise in European debt, European yields and UK yields and even US yields impact us?
So, Lata, the essence of this problem is the way developed market central banks led by the US Federal Reserve are positioning their reaction functions. So they are basically in essence saying that we will keep hiking till we see inflation turn. Now one understands why they are positioning it this way, because they are tightening via financial conditions in the financial markets. So they want credit spreads to widen, probably equity prices to normalize. They want real bond yields to rise, and all of that to have an impact on aggregate demand. Whenever they have started to provide nuance to their reaction function, markets have thought that they will pivot and they have eased financial conditions. Markets have eased financial conditions, which the central banks don't like. So we are almost in the midst of a tantrum on monetary policy normalization, because the pace at which rates are rising in a world that is now much more indebted than it was 10 years back is bound to cause some sort of a financial market accident. It could be at an emerging market country level. It could be on periphery spreads in the Eurozone that you just discussed. It could be at company level, refinancing level, etc. So at some juncture, probably this factor comes into play. Okay. In certain geographies, it has already coming into play. So you discussed the UK market, for example, where the Bank of England is actually having to expand balance sheet temporarily, which is counter to the inflation management framework that it's been operating with. But at some juncture, and probably these IMF, World Bank forums are helpful there, financial stability risk has to be put into the picture, and probably incremental financial market tightening is not desirable.
Okay.
Because there's absolutely no sense going one way and then U-turning for a bit of 10-15 days in order to address financial stability issues. And the sensitivity that world markets have to every incremental data point that comes out of the US has to subside. So for example, if you look at bond volatility indices, they are at multi-year highs and they're refusing to come off. I mean, probably, bond traders or financial market participants are psychologically just not geared to take this amount of day-to-day position management stress and, potentially the risk of something breaking in the very near future.
And you actually phrased it. Yeah, Suyash, you phrased it very well. Bond market is not prepared for this level of volatility. I think nobody at any point in time in our own lifetimes have been prepared for so much of a rate hikes in so short a time. It is not the 4% level or the 5% level, but the fact that it has come in 9 months. And perhaps what we have not realized is that a large number of financial institutions have leveraged on these zero interest rates or low interest rates, and they may create a problem before the interest rates start depressing demand. The central banks are raising rates to depress demand, but before that a financial accident may come. Alvin Tan, that's my question to you. Even before inflation falls or aggregate demand falls or US labor market unemployment starts increasing, can there be a financial accident in the form of some pension funds going belly up?
Yes, certainly. We could see that is a clear and present risk, which is why the Bank of England intervened the way it did 2 weeks ago. Regarding UK pensions and their bond holdings. I mean, that said, though, I mean, it's pretty clear from Governor Bailey's comments yesterday that Bank of England still considers the fight against inflation the primary concern at this point. So, I mean, he reiterated that the bond buying will not persist beyond this Friday. I mean, it'll be interesting to see how the market continues to push the Bank of England in this regard. So definitely the risk of a financial accident has increased across the board, I would say, as yields, both nominal and real yields, continue to rise further, and also the US dollar continues to rise further. I mean, the rise in the dollar, I think, is almost as important as the rise in global yields. I mean, higher US dollar does tend to tighten monetary conditions in emerging markets.
Oh, yes, that's the other angle which I could not fit in. In the global financial crisis, it looked like the US was weak and several other countries had better capital buffers for their banks. Now it seems to be the other way around. US economy is extremely strong and therefore they can stomach rate hikes, but the rest of the world has a problem if the dollar strengthens so much. I take your point over there. But do you think the central bankers, okay, this question to you, Suyash, and then I'll come to Alvin. Do you think the central bankers are now, at the moment, all of them are in the fund IMF World Bank meet? Do you think some agreement may come, or do you think we are going to see more accidents? What I mean is, are we in the tail end of the debt crisis, or are we in the beginning?
So this is not easy to answer, simply because I think developed market central banks have lost faith in their power to forecast. So, the lagged impact of monetary policy hike that will impact growth and inflation, let's say 1 year down the line, holds very little currency with them at the moment, which is why, the positioning of the reaction function, that we need material change in data now. Now, obviously, it's very hard for the US Fed to say, because of global considerations, I will ease the fight on my inflation, because they are very worried that the inflation expectations, should they unanchor, it's very difficult to bring them back. So for the time being, I think there are no easy solutions to this, but you will probably continue to see country level interventions. Whether they become coordinated, probably that takes a little bit more time. It's already happening in a couple of markets where financial stability risks temporarily have overtaken the fight against inflation. But as more things continue to break around the world over the next 2 or 3 months, I would suspect at some juncture this becomes more coordinated, although probably we are still not there yet.
Okay, same question to you, Alvin. Are we in the midst, the start of the crisis, or are we at the tail end? Do you think the central bank commitment to lowering inflation and going ahead is giving them a blind spot on financial stability?
Well, I think that definitely the central banks, in the G10 central banks, focus remains firmly on containing inflation. Therefore, interest rates will continue to rise further. That said, though, we do not expect the Fed to persist in 75 basis point pace of hikes beyond the next one in November. So we do think that there will be an easing of the Fed's pace of hikes, although admittedly, that is very dependent on the inflation data.
One minute.
To see a slowdown in inflation momentum in the US.
Alvin, 1 minute.
So indeed, if that is the case, that the Fed's last 75 basis point hike is the next one, and after that it goes lower. I do think that we could perhaps evade a major financial crisis as the Fed continues to hike, and we think that the Fed's terminal Fed funds expectation, the median Fed dot for next year of approximately 4.6%. I think that's a fair one. And so if we do get there by middle of next year, then I think that we could evade a major financial crisis. But no doubt, the global economy is slowing down and will continue to slow down. But that is absolutely necessary to bring inflation under control.
Okay. Well, I guess I've just started the discussion and I'll have more of these. Alvin and Suyash, I'm out of time, but this is a spot we have to watch. The global developed market debt markets, which may get a financial accident before the central bankers are able to lower the inflation in those countries. So will central bankers pull back their rate hikes and concentrate on financial stability like the BOE has done? Will something skip their notice and there is a domino effect of a big institution failing? All these are possibilities on the table. We are going to live in difficult times, or as the Chinese say, interesting times. Wrap up on Bazaar on that note. Chartbusters bringing you more equity IT.